What is the role of a central bank in monetary policy? Have you ever wondered how a central bank influences the economy? The role of a central bank in monetary policy is essential for managing the economy's money supply and interest rates. Let's break it down. Monetary policy is the process that central banks use to control the amount of money in circulation and the cost of borrowing. This is vital for achieving goals like price stability, economic growth, and employment levels. The central bank is the only institution that can issue the national currency, giving it unique power over the economy. One of the key functions of a central bank is setting policy interest rates. These are the rates at which commercial banks can borrow money from the central bank. When the central bank changes these rates, it directly impacts short-term interest rates in the money market. This, in turn, influences how much people and businesses borrow and spend. For example, if the central bank lowers interest rates, borrowing becomes cheaper. This encourages businesses to invest and consumers to spend, boosting overall demand in the economy. Conversely, if the central bank raises interest rates, borrowing costs increase, which can slow down spending and investment. The central bank's main goal is often to maintain price stability. This means keeping inflation low and predictable. When prices are stable, it helps people and businesses make better financial decisions. It reduces uncertainty, which is good for economic growth. While monetary policy can have short-term effects on economic activity, its long-term impact is mainly on price levels. It does not permanently change factors like productivity or population growth. Instead, it helps guide inflation to a target level, ensuring a stable economic environment. To achieve its objectives, the central bank uses various tools. Adjusting policy interest rates is the most common method. However, in some situations, the central bank may also engage in quantitative easing. This involves purchasing financial assets to lower long-term interest rates and increase money supply. Through these actions, the central bank manages liquidity in the financial system. It plays a vital role in steering inflation and interest rates in line with broader economic goals. By doing so, the central bank supports sustainable economic growth and stability. In summary, the central bank is crucial in shaping monetary policy. It controls the money supply and borrowing costs to maintain price stability and influence economic activity. This helps create a stable environment for growth and prosperity.